you always wanted to know so much more about investing? Do you wonder how people go about it? How people actually make money from investing? This is what this video is going to be talking about. Starting as a beginner in the investing world, gradually making you familiar to what it's all about. And today we'll be talking about the terms of investing. Sometimes you hear terminologies and you wonder what they mean. They are flung about in our faces and you don't know what exactly to make of them. Grab your chair and a cup of tea and let's see the terms. So what's investing? Investing is you putting your money into a venture or into something, hoping to make a profit from it at the end of a particular period. The first thing we'll talk about is asset classes. Asset classes are ways to categorize our properties, our belongings, and putting each and every one of them in a bucket. The first are stocks. They are also referred to as equities. The risk level of stocks are pretty high, and so is the return. By risk, I mean the probability of you losing money is pretty high, and by the returns, the probability of making profit is also pretty high. Examples are buying stocks of Amazon, of Apple, Coca-Cola, and so many other companies. The next to it are bonds. Bonds are moderately risky, and so are the returns as well. The returns are very moderate. The volatility is pretty low compared to stocks, and the most secured ones are the government bond. Next are real estates. The risk in real estate is moderate to high, and the returns are pretty moderate to high as well. This could include direct ownership in real estate, physical properties, or owning real estate through REITs. That's the Real Estate Investment Trust. They own and manage the buildings and they share the profits with you. Next are commodities. They include raw material like oil, agricultural products, supply, gold, wheat, and so on. The risk level is high and their returns are pretty high too because they respond very fast to fluctuations in the market and economic conditions. And the last of the asset classes are cash equivalents. That's your cash sitting in the savings account, money market funds, short-term certificates of deposits. Their risks are pretty low and the volatility is really low as well. And so are the returns, very low. Next we'll talk about asset allocations. What are asset allocations? It's the way you spread your assets, the way you spread your investments across the different asset classes that we just discussed. And that will depend on your time horizon, how long you want to leave the money in the market for, your tolerance risk, is it high or low, and the goals of investing. Do you need it in the short term, in the long term, in the medium term? All this guides how you allocate your assets. Bear market. What are they? When the market is experiencing extended decline in stock prices, typically a drop of 20%, they are said to be in the bear market. And the bull market, just like the bear, it attacks from up, down. And then the bull market, we are said to be experiencing a bull market when there's a steady rise in the price of stocks, just as the bull attacks from down, upward. Let's talk about capital appreciation. What are they? It's an increase in the value of your assets. The capital is said to have appreciated when the price you can sell it for is more than the price you purchased it for. Capital gains and capital losses. Only realize a capital gain or a capital loss when you actually sell the investment, and you're said to have a capital gain when the price you sell it for is more than the purchase price, while you realize a capital loss when the price you sell it for is less than the price you bought it at. So a capital gain is you selling a stock you bought for $10 at $15. Meanwhile, a capital loss is selling a stock you bought for $10 at $7. Compound interest. They are interest earned on both the initial principal amount that you invested with and all the accumulated interest from time to time, depending on how long you leave it in the market. Diversification. That's spreading, that's dividing, distributing your assets amongst various asset classes to manage your risk. Dividends, what are they? They are when the company makes some profit, whatever shares, whatever stocks you have bought, the company makes some profit and they take a portion of that profit and decide to share it amongst the shareholders, saying thank you for investing in our company. Exchange traded funds, ETFs. They have become very popular these days. They are a basket of securities, a basket of stocks, a basket of bonds, and trades as if it's a single stock. So in that basket, you could have up to hundreds or even thousands of stocks of companies inside one basket, and you are buying that as a single unit of stock. Hedge. When you talk about hedge, what is it? So it's a strategy in investment, and it is used to manage risk. You buy insurance to protect things that are valuable to you, so you don't incur great loss if anything happens to it. The same also happens with hedging. If an investment is valuable to you, you hedge it by buying another one, such that when the price of one goes down, the other is sure to go up. Initial public offering, IPOs. What are they? It's the first time a company comes to the public to offer their company's stock on the stock exchange. They could have had private funds, but this time they are open to the public to buy shares in that company. Index funds. They are used interchangeably with mutual funds or ETF. They mimic a specific market index. Take for example, you have an index for S&P 500 and you want to buy an index fund that mimics that performance. They are referred to as index funds. They give you a broad exposure to a lot of stocks at once. Let's move to liquidity. It simply means how difficult it is for you to buy or to sell an asset. Stocks sell every day, so their liquidity is high. It's easy for you to dispose it and it's easy for you to acquire it. While real estate, the liquidity is low because it's more difficult to sell it and it's more difficult to buy one. Market capitalization, sometimes referred to as market cap. It tells you the size of the company regardless of whatever stock price it's going for. A company with a market capitalization of 1 billion is definitely considered larger than a company with a market capitalization of say 500 million, irrespective of what their stock prices are. That made me remember someone who thought because the stock price of company A is $100, it's more expensive than the stock market of company B, which is just $20. But really, that's not how it works. It all depends on how many slices they decide to cut their market capitalization into. Let's say, for example, we both have the same medium-sized pizza. You decide to cut yours into 8. I decide to cut mine into 16. That makes the stock prices cheaper, but our market capitalization is still the same. So it's not in the price of the stocks, it's about the market capitalization. Market risk. There are inevitable risks that is associated with the market. The overall possibility of losing due to economic factors, supply and demand, investors' emotions, and so many other reasons. Mutual funds. They are actively managed investments by professionals. And that could include stocks, bonds, or a combination of both. Portfolio. What are they? They are the collection of all your investment belongings. Risk tolerance. That's our personal capacity and level of taking risk in exchange of possible high returns. And if the returns are not what you expect, you are able to cope with it. A lot of times, returns are associated with the risk involved. If your risk level is pretty high, you're ready to lose money, then you have the probability of making money. If you're not ready to lose any of your money, you also have a low returns. Returns on investments, the acronym is ROI, it's measuring the profits or the gain compared to the cost at which you bought the assets. Securities, they are financial instruments like stocks, bonds, mutual funds that you can use to raise capital when you need them. They're like IOUs. Share is a single unit of what you own in the company. It's comparable to a single piece from the round pizza, while stock is a general term for the whole pizza itself, that is, ownership in a company. The last one we'll talk about today is time horizon. That's the period in which you plan to leave the money in the market for, possibly before you would need it. This is not an exhaustive list, but it would sure give you a solid foundation of the fundamental terms that are used in the investing world. It is important for you to gain a good understanding of the market before you put your hard-earned money into it. I invite you to explore the interesting world of investment by starting early, investing regularly, and having some good understanding. My name is Omo, your personal finance coach. Feel free to book a free consultation if you need more help. And until we see you in the next series, keep being smart with your money.